Breaking news, the Dow continues its slide, triggering circuit breakers across the board. But analysts are already pointing towards signs of a rapid V-shaped recovery.
Hey everyone, welcome back to MoneyTrendMomentum. My name is Vishwas. I've been looking at the same charts you're looking. And lately in the markets, everything is going down. There's complete downward movements since this year. Starting this year, the market peaked. Every market peaked like nothing else. But starting February, it started to dip. The headlines, let's be honest, they're a complete mess. People are talking about slower growth like it's the end of the world. And every time the Nifty and the S&P 500 dips, the profits, the crash profits specifically, they come out of the woodwork. But while everyone else is panicking about the next few weeks, I'm looking at the next few years. There's a massive financial opportunity forming right now. And today, I want to walk you through why the next big move is more closer than you think. We are going to talk about tech, energy, and the mess that has been created by the global politics. And I'm going to give you the most probable and possible and realistic levels where the markets are going to bottom out. Let's dive in. But before we continue, here's a quick disclaimer. This video is not financial advice. It is for educational purposes only. I'm not a registered financial advisor. And before you make a move in the market, do your own analysis and consult a qualified financial advisor. Then you can invest in the markets. Investing money in the markets comes with substantial risk of loss. First, let's talk about two things that are actually moving the markets. The tech and energy. The transition from AI speculation to AI execution phase is defined by the rise of Agentic AI and custom silicon. In the beginning, AI was just a chatbot, but now people are creating their custom AI agents to do various tasks for them, whether it's for replying an email or scheduling an event or booking a ticket or reservation to a flight or something, anything. And these chatbots, they're being built by normal people using various LLMs like Cloud Code and OpenClaw. In 2026, enterprises are moving away from simple chatbots towards autonomous multi-agent systems, described as digital assembly lines. The specialized agents collaborate to handle end-to-end complex business processes. Simply put, think of digital assembly lines like a team of digital employees doing the work for you. This shift is supported by a custom ASICs. What do I mean by ASICs? They are application-specific integrated circuits. Essentially, these are the chips specifically made for one job, like Google's TPU version 7, Amazon's Trainium 3, and Microsoft's Maya. These proprietary chips allow companies to bypass the expensive GPU bidding wars and run high volume workloads with 40 to 60% better price performance and significantly lower energy consumption than the general purpose hardware. To keep these powerful systems running, companies like Vertiv are aggressively acquiring thermal management specialists to provide direct chip liquid cooling system. Vertiv Holdings is an American multinational company that provides critical data infrastructure and continuity solutions for data centers, communication networks, and industrial environments. Center reads like Equinix are redesigning facilities specifically for these high density loads. And you can't have AI without power. That brings us to energy transition. The global energy transition has undergone a fundamental shift in 2026, moving from a moral net zero imperative to a pragmatic focus on the industrial competitiveness and energy security. It's not just about being green anymore. It's about staying powered up. This evolution is largely driven by the AI power bottleneck, where the massive electricity that is needed to keep these data centers running is projected to be over 500 trillion watts globally this year alone. This has made power a reliable strategic asset for any nation. Beyond the hardware, the industry is increasing its focus on grid intelligence, using AI to control the energy flows in real time. This includes predictive modeling to manage peak loads and the integration of virtual power plants. Now, what is a virtual power plant? A virtual power plant is a digital network of decentralized energy resources that are aggregated and managed by a central control system to function as a single coordinated power plant. Unlike traditional power plants located at a single physical site, virtual power plants are geographically dispersed. Now, what do I mean by this? These virtual power plants are ranging from residential solar panels or a home battery for charging the EVs or the smart thermostats that turns electric vehicle fleets and smart buildings into a distributed battery for the grid. Between AI data centers and the massive rollout of smart grids, the demand for energy is skyrocketing. We're seeing a record growth in decentralized power. Now think of it like this: a bunch of communities having their own microgrids and massive battery storage. If the company is helping the world solve the power hunger of AI, they're sitting on a gold mine. Now let's talk about the geopolitics. I know politics is a headache, but in 2026, geopolitics is a power. We have got a more interventionist US foreign policy that is shifting trade deals, and a lot of great diversification is happening. In 2026, I'd like to call it the era of laissez-faire globalization. What do I mean by this? In this kind of globalization, the free-flowing trade with minimal government intervention has been replaced by a more fragmented government controlling form of globalization, focusing on national security. In the past, we were trading with whoever has or had the cheapest rate in the market for any goods. But that has been completely replaced by strategic regionalization and state interventionism. Geopolitical volatility, particularly the escalating US-Israel conflict with Iran and disruptions in the Strait of Hormuz, has forcefully shifted from cost-driven practices to security-driven supply chains. Governments are now treating critical infrastructure like AI models, data centers, and semiconductor plants as a national security asset rather than a mere commercial good. This shift has triggered a massive industrial boom in India and the United States as both nations aggressively pursue the self-reliance policies. Now, as I'm talking about India, India is on the track to overtake Japan as the world's fourth largest economy this year, fueled by an increase in the manufacturing sectors like precision equipments, electronic assembly, and specialty chemicals. Simultaneously, the US is seeing its highest levels of domestic industrial investment in decades, driven by subsidies for custom silicon and green energy infrastructure. Let's get into the quarterly earnings. Q4 results are just around the corner, and the probability, it's a mixed bag. We are seeing what I call an earnings divergence. The Q4 2025/2026 earnings seasons is characterized by a strong earnings divergence. Now, as I said, what do I mean by an earnings divergence? Earnings divergence is the two components. They are AI-driven compounders and the normal rate sensitive laggards. Tech giants have largely validated the AI execution phase, with information technology and communication services sectors reporting double-digit earnings growth, which could be averaging anywhere between 25 to 32%. This is mainly fueled by the cloud expansion and the internal operational efficiencies. While massive capital expenditure on AI remains a point of investor scrutiny, but on the other hand, firms like Microsoft and Meta have demonstrated that AI integration is protecting margins against broader inflationary pressures, effectively creating a tech island of resilient profitability. While all this is happening, this is leading towards a slower growth of the economy where the soft landing test is occurring. Now let me explain detailedly what do I mean by this. Big tech and high-end industrial firms are showing great margins because they have used AI to cut costs. But on the other side, consumer-facing sectors are feeling the pinch of the slow growth. In 2026, the global economy is navigating a deliberate cooling period, with the GDP projected to settle at a steady but spectacular 3.3%. This slow motion growth is a byproduct of the high interest rates and fading post-pandemic fiscal buffers, which have finally begun to dampen labor demand and consumer spending. For central banks, deceleration is the intended outcome of a 3-year battle against persistent price hikes. As supply chain disruptions ease and energy costs retreat from the early 2026 peaks, global headline inflation is expected to decline toward a 3.8%, providing necessary evidence for the policymakers to transition from a restrictive stance to a neutral one. The IMF projected global growth around 3.3% for 2026. This sounds slow, but remember, slow growth is often the Goldilocks zone for the investors. It's slow enough to keep the inflation down, which means the central banks can finally stop being the bad guys and start easing on the interest rates. We are in that bridge period right now. Right, now let's talk about the markets. The question that you all want answered: how long can we go? How long will the markets move down until they actually reverse? Let's look at the S&P 500. Technically, we are seeing some selling pressure. As of April, S&P 500 is navigating increased volatility, having recently broken below the 200-day simple moving average near 6,635. This technical shift has placed the immediate focus on a critical support zone, essentially a safer flow between 6,345 and 6,550, which aligns with the lows seen in late 2025. If macroeconomic pressures such as the surge in the oil prices and a revised Federal Reserve inflation forecast of 2.7%, which continues to weigh on the sentiment, analysts warn of a potential hard downside test. This could trigger a temporary spike toward a 6,000 psychological level, serving a cleansing correction before the index finds a more permanent base for the next leg of the AI-driven cycle. But according to my analysis, I think the S&P 500 will bottom out around the range of 5,780 to 5,890. It could reach this point and try to reverse. Let's look at the Indian markets. The Nifty 50 is facing a bearish to cautious environment as high valuations collide with a period of subdued earnings growth. After starting April with a significant gap down due to geopolitical tensions, the index is testing the immediate support at 22,000 with a stronger historical demand zone sitting between 21,700 and 22,000. While the short-term bias remains weak, institutional desks like Jefferies suggest that this correction is bringing valuation back towards pre-COVID averages, making the 21,750 and 22,000 range a compelling value buy area. I agree with Jefferies. The market could bottom out around 21,750 and 22,000 range, but that's only if the geopolitical tensions ease out in the Middle East. If it doesn't ease out, according to my own analysis, I think the market will go even down. A possible strong support zone for the market will be around 20,000. Now, most of you would be thinking, when would this reversal occur? The consensus for the market reversal point is leading towards a late Q2 or Q3 of 2026. Now, you may ask why the market may reverse around Q2 or Q3 of 2026. This is a timeline that hinges on a monetary pivot, a change in the direction from the global central banks. While the Federal Reserve recently held rates steady at 3.5 to 3.75%, markets are looking towards June 2026 meeting for a potential signal of the first of the 3 projected rate cuts for the year. Similarly, the RBI has maintained a neutral stance with the repo rate of 5.25%, signaling a wait and watch approach. A reversal is expected to materialize once inflation data clearly cools, allowing central banks to shift from a restrictive hold to an easing cycle that reinjects liquidity into risk assets. Now, in this part, I want to talk about mutual funds and its blueprint. So, when do you think that mutual funds will stop being shaky? The mutual fund volatility in 2026 is closely tied up to the fear gauge, with historical data suggesting that stability typically returns when India VIX drops below 15 to 18 point range. As of early April 2026, the India VIX has experienced spikes above 25 due to the global tech sell-offs and geopolitical tensions, lending to a significant mark-to-market pressures, which means the current value of the portfolios is swinging wildly. For the mutual funds to be stabilized, it also requires the US 10-year Treasury yield to settle. The current forecast suggests that the stabilization is around 3.75% by the year end. Once these indicators quiet down, the aggressive sell-on sentiment that has characterized the first quarter is expected to shift toward a more neutral stance. During that or after that period, we can see the cooling off period of the FII selling pressure. The heavy selling by the foreign institutional investors, which saw a net outflow exceeding 8,000 crores in a single session in the early April, is expected to cool down once Q4 performance of the financial year 2026 earnings are fully priced into valuations. While FIS have been retreating to safer assets amid high US rates and rupee volatility, domestic institutional investors and robust SIP inflows now are exceeding 31,000 crore on a monthly basis. This continues to act as a massive liquidity cushion. If you're looking forward to where you want to put your money for the highest possible future returns, here are some of the sectors that you need to consider. The first one is IT and AI infrastructure. The revenue projections for the AI market are hitting nearly $30 billion. This is a multi-decade cycle investment. And the second one is energy and power, specifically companies involved in smart grids and green hydrogen. The third one is financial services. As the economy formalizes, the leaders in the banking and NBFCs are going to capture a massive amount of the new wealth that is being created. And the fourth one is manufacturing industries. In 2026, sectors like electronic exports have seen a 47% jump driven by the operations of the major semiconductor units and PLI schemes. This industrial boom isn't just about cheap labor, it's about a technological intensity shift. While domestic firms are integrating into a global supply chains for everything from EV components to high-end communications hardware, aiming to double the manufacturing exports by 2030. And the fifth one, the pharma and the healthcare. Pharma remains a quintessential defensive play, a safe bet for the 2026. This foster validation cycle is attracting fresh capital into the biotech and healthcare. As investors look for non-discretionary growth, things people have to buy regardless of the economy that remains resilient, even as consumer spending on the retail and travel cools due to high interest rates. Look, the next big opportunity isn't about finding the magic stock that goes up by 1,000% in a week. It's about recognizing these massive shifts in technology, energy, and global trade before the rest of the world catches on. Now, the levels are set, the sectors are clear, and the slow growth is just the calm before the next leg up. Stay disciplined. Don't let the headlines scare you out of a good position. I'll see you guys in the next video.